Hello and welcome to Kotak Life's Market Outlook for May 2023. We had a turbulent March. Banks were failing globally, not just regional banks in US but even some large European banks. In that backdrop, the financial systems looked very fragile, and at least Reserve Bank of India in its wisdom decided to pause its rate hiking cycle. Also, probably in line with our view, Reserve Bank of India communicated that the past rate hikes are already enough to take care of the inflationary pressures within the system. Subsequently, we had a fairly sedate April, a non-event month. India's inflation print in that month also was, at least lower than the upper tolerance band of MPC at 5.66%. So, is all taken care of? Rates have peaked, yes, more or less locally and globally both. One odd hike will not change this narrative, but whatever it is, I think more or less interest rates have peaked within the systems. But when does this peak become a pivot? Now that's $1 million question, and I think there are multiple ways situations can evolve from here. One of the ways, and the most Goldilocks scenario, is that all the pent up pressures of inflation are addressed by the past rate hikes, and it naturally slows down enough to come at the central bank target rates, not just locally but globally, and the situation is taken care of. And not only that, it happens materially quickly, say in a matter of at least a quarter or two, if not sooner. If not so, then central banks may have to go for a few more rate hikes, however reluctantly. And I say reluctantly because no central bank likes to hike rate when they see cracks in the financial system. When institutional stability is endangered, they're normally a bit careful. Having said that, this inflation seems a bit more stickier than what we have seen over past decade, and that may lead to them probably lured into hiking one or two more times, a bit reluctantly, whichever way. If that happens, we really land up in a situation where a hard landing is a possible scenario. A crash, maybe some failure again within the financial system, may or may not be manageable. A sudden crash in the economic activity or labor market, and that is normally a turbulent situation. I'm sure they would like to avoid it, but I'm sure that nobody is able to fine tune the policy making to the last nuance. And the last possible scenario is that we probably stay in what I would dreadfully call a stagflationary scenario, where while the growth materially slows down, the inflation just refuses to budge. It doesn't normally happen, it's a very rare thing, but it is not an impossibility as well. It is not our base case scenario as well. In our view, I think we are more or less done with the rate hikes, but the pause is a bit extended one. Markets may be, at least the fixed income markets, may be a little too eager to see rate cuts, and their patience may be tested. Rate cuts may not be forthcoming within a matter of months, but it may take until probably mid-second half this year before we see any signs of a pivot. And that too, because central banks will want to take sufficient comfort, not just from the direction of the inflation, but also from the magnitude of the same. And only when they have sufficient comfort that, the inflationary genie is back in the bottle, is when they probably transition to a pivot. So will my fixed income investments start performing instantly? Probably no, some more patience on that. Will my home loan rates come down from here? Most likely yes, but again it's a matter of a few quarters before the same happens. There is good news for fixed income investment, but probably like most things in life, it will demand a bit of patience. Until then, we will be mostly in a range-bound markets. The global economic situation and a scare of a failure within the financial systems will keep a lid on interest rates, while the supply pressures would probably keep a floor on the same. Only a promise of cut is when the next material meaningful direction in rates come about, and like we said, it's a little longer before that fructifies. Between now and then, it's going to be a push and pull environment with range bound rates. and the shape of the yield curve is most likely to steepen, because as we head into a scenario where economy is slow and the promise of a rate cut fructifies, the short end of the yield curve will react more, it will benefit more in anticipation, and with the promise of rate cuts it will perform more, while the longer end of the rate cuts will start pricing in the fiscal stress on account of slowing growth, and hence probably a bit more pressure on the longer end yields. So the shape of the yield curve is most likely to steepen from where we are, but again all this is a matter of when we actually start expecting the rate cuts. Between now and then it's a game of patience, as is often so in the markets. So yeah, we expect a rangy month of May, and hopefully nothing fails between now and then. Happy investing. Thank you.